This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions.
Every trader has had this moment. A stock you are watching starts to rally. The candles are green, the chart looks beautiful. Everyone on social media is calling it the next big breakout. So you buy in. And within a week, the whole move fizzles out, reverses, and you are sitting on a loss wondering what went wrong. Here is what went wrong. You looked at price, but you did not look at volume. Price tells you what is happening. Volume tells you whether it is real. A rally on rising volume has institutional conviction behind it. Real money is flowing in. But a rally on declining volume is a warning siren that most people completely ignore. It means fewer and fewer participants are pushing price higher. The conviction is fading. The move is running on fumes. In this lesson, you are going to learn how to read volume alongside the trend to determine whether a move is healthy and likely to continue, or quietly dying and about to reverse. This is the difference between trading with confidence and trading on hope. And it applies to every stock, every ETF, every market. But it is especially critical right now in the AI and semiconductor space, where rallies can look explosive on the surface but tell a very different story underneath. Let us break it down. Let me start with the foundational principle. Volume confirms the trend. What does that mean? It means that in a healthy trend, volume should expand in the direction of the trend and contract during pullbacks. In a healthy uptrend, the green days, the rally days, should have higher volume than the red days, the pullback days. This tells you that buyers are more aggressive than sellers. Money is flowing in on the advances and stepping aside on the dips. In a healthy downtrend, it is the reverse. The red days should have higher volume than the green days. Sellers are more aggressive. Institutions are distributing. This is one of the oldest and most reliable principles in technical analysis, and it works because of basic supply and demand. If more volume is happening on the up days, there is more demand. If more volume is happening on the down days, there is more supply. Think about what has been happening in the semiconductor sector over the past year. When stocks like A.M.D. and A.M.D. were in their strongest phases of the rally, the big green candles consistently had higher volume than the small red pullback candles. That was the market telling you, in real time, that the trend was healthy, that institutions were buying the dips, that the smart money was still accumulating. If you knew how to read this one signal, you would have had significantly more confidence holding through the normal pullbacks instead of panicking out every time the stock dipped 2 or 3%. Let me walk you through exactly what a healthy uptrend looks like when you add volume to the picture. You have price making higher highs and higher lows, which is the textbook definition of an uptrend. Now look at the volume bars underneath. On the rally legs, the moves from the lows to the new highs, volume is expanding. Each push higher comes with more participation than the previous one. The bars are getting taller. On the pullback legs, the small dips within the trend, volume contracts. The bars get shorter. Fewer people are selling. This creates a pattern I call the volume heartbeat. Rally, loud, pullback, quiet. Rally, loud, pullback, quiet. When you see this rhythm, the trend is healthy. The buyers are committed. The sellers are not interested in pressing the issue. The institutional money that drives major trends is still adding to positions on weakness and holding through the rallies. Here is a practical way to check this on TradingView. Pull up any stock you are watching. Add volume. Then visually compare the volume bars on the green candles versus the red candles over the past month. If the green bars are consistently taller, you are in a healthy trend. It takes about 5 seconds and it tells you more about the quality of the move than any lagging indicator. Now let us look at what happens when a trend starts to weaken, because this is where most traders get caught off guard. On the surface, the price chart might still look fine. The stock is still making higher highs. It is still going up, and that is why people keep buying. But underneath, the volume is telling a completely different story. In a weakening uptrend, the rally legs start showing lower volume. Each new push higher comes with less participation than the previous one. The bars are getting shorter even as price goes higher. Meanwhile, the pullback bars start getting taller. More selling is happening on the dips. This is the volume divergence pattern, and it is one of the most powerful warning signals in all of trading. Price is going up, but volume is going down. The trend looks healthy on the surface, but underneath it is quietly dying. Think of it like a car running out of gas. The car is still moving forward, but it is decelerating. If you are watching the speedometer, which is volume, you can see the speed dropping long before the car actually stops. If you are only watching the position, which is price, you do not notice until you are stranded on the side of the road. This is exactly how the smart money operates. Institutions start selling during the late stage of a rally, but they do it gradually.
They are not dumping everything at once. They are distributing, selling a little bit each day into the strength. From the outside, the chart still looks bullish, but the declining volume tells you that the big players are quietly heading for the exits.
Let me get specific about volume divergence because I want you to be able to spot this in real time. Volume divergence occurs when price makes a new high, but volume does not make a new high. The stock pushes to a higher price, but with less energy than the previous push. Here is the step-by-step process for spotting it. Step 1. Identify the current trend direction. Is the stock in an uptrend? Step 2. Compare the volume on the current rally leg to the volume on the previous rally leg. Is it higher or lower? Step 3. If the current rally has significantly lower volume than the previous rally, that is divergence. Flag it. Step 4. Check the pullback volume. Is the volume on the dips increasing? If rally volume is decreasing and pullback volume is increasing, you have a double divergence. That is the strongest warning sign there is. Now I want to be clear about something. Volume divergence does not mean sell immediately. It is a warning, not a signal. The trend can continue for days or even weeks after divergence appears. What it tells you is that the quality of the move is deteriorating. Use it to tighten your stops, reduce position size, or stop adding new money. Do not use it to short a stock that is still making higher highs. The divergence tells you to get cautious, not to get bearish. The actual reversal signal comes later, usually a break of support on heavy volume. That is when the trend officially changes character.
Quick pause. If you are getting value from this series, hit that like button, subscribe if you have not already, and tap the bell for notifications. It takes 2 seconds, and it helps the channel grow so I can keep making this content for free. And if you are sharpening your career alongside your trading, check out Resume Zenith. Clean, professional resumes that get you noticed. Link in the description. Alright, back to the lesson.
Alright, let us put this all together with a practical framework. How do you tell if a rally is real or fake? Here is the checklist. Signal 1. Volume expanding on the rally legs. Each push higher should ideally come with equal or greater volume. This shows growing conviction. Signal 2. Volume contracting on pullbacks. Light volume dips mean holders are not selling. They believe in the move. Signal 3. Breakouts above resistance happen on above average volume. When the stock pushes through a key level, volume should spike. That confirms the breakout is legitimate. Signal 4. No volume divergence. Price and volume are moving in the same direction. New highs come with new volume highs, or at least comparable volume. If a rally passes all 4 of these tests, it has a high probability of continuing. If it fails even 2 of them, be cautious. And if it fails all 4, rising price on declining volume, heavy selling on dips, weak breakout attempts, and clear divergence, you are looking at a move that is about to fail, regardless of how good the chart looks on the surface. This framework works on any stock, any time frame, any market condition. But it is especially useful for AI and semiconductor stocks because these names attract so much retail attention that the price action alone can be misleading. The volume underneath tells you whether the institutions are actually backing the move or whether it is just retail hype pushing prices around. Now let us flip the script and talk about downtrends, because volume works in reverse during a decline and you need to understand both sides. In a healthy downtrend, the heavy volume days should be on the red candles and the bounces should have light volume. This tells you that sellers are in control. The institutions are distributing, pressing the stock lower, and any rally attempt is met with indifference from the big players. When does a downtrend show signs of ending? When you start to see the same divergence pattern we talked about, but in reverse. The stock makes a new low, but volume on that new low is lower than volume on the previous low. Less selling pressure, fewer people are panicking, the weak hands have already been shaken out. Meanwhile, the bounce attempts start showing higher volume. Buyers are stepping up. This is volume telling you that the character of the decline is changing. The sellers are running out of ammunition. When you see declining volume on new lows combined with rising volume on bounces, the downtrend is losing steam. It does not mean the bottom is in yet, but it means you should be watching closely for a reversal signal. And here is the key lesson. The best bottoms usually come with a climax event, which we covered in Lesson 12, followed by this volume divergence pattern. The climax shakes out the last sellers, and then the divergence confirms that selling pressure has dried up. If you combine Lesson 12 and Lesson 13, you have a powerful framework for spotting major trend changes. Let me give you one more practical tool that ties everything together. Relative volume. Instead of looking at raw volume bars and trying to eyeball whether they are high or low, you can use a volume moving average to create an objective benchmark. Most charting platforms, including TradingView, let you overlay a moving average on the volume panel. I recommend using a 20-day simple moving average of volume. This gives you a line that represents the average daily volume over the past month. Now, when you see a volume bar, you can immediately tell if it is above average or below average. Rally day with volume above the moving average means strong buying interest. Rally day with volume below the moving average means weak, unconvincing buying. Pullback day with volume below the average means healthy, low-pressure dip. Pullback day with volume above the average means aggressive selling and potential trouble. This simple overlay turns volume analysis from art into science. Instead of guessing whether a bar looks big or small, you have an objective reference line. Add it to your charts right now and you will immediately start seeing the trend health signals we have been discussing. It makes the entire framework we covered today 10 times easier to apply in real time. Homework time. This is going to be the most eye-opening exercise in the entire volume series so far. Step 1. Go to TradingView and pull up the chart of the Semiconductor ETF, SMH. Step 2. Add volume to the chart. Then add a 20-period moving average to the volume panel so you have that benchmark line. Step 3. Zoom out to the daily chart and find the last 3 major rally legs. For each one, answer this question. Was the volume expanding or contracting during the rally? Step 4. Find the last 3 major pullbacks. Was the volume on the pullbacks lighter or heavier than the rally volume? Step 5. Look at the most recent price action. Is the current move, whatever it is, showing healthy volume characteristics or divergence? Write down your assessment, healthy, cautious, or warning. For extra credit, do the same analysis on one individual stock within the semiconductor sector, NVIDIA, A.M.D, Broadcom, or whatever you are watching. Compare the individual stock volume health to the sector ETF volume health. Are they telling the same story? That comparison alone will teach you more about market internals than most trading courses. And the complete volume trend health checklist is in your free cheat sheet at candlelogictrading.com. And now you have one of the most valuable skills a trader can have, the ability to judge whether a trend is real or dying before price confirms it. Volume expanding with the trend means healthy. Volume contracting against the trend means healthy. But when you see divergence, when price is moving but volume is fading, that is your early warning system telling you something is changing underneath the surface. In the next lesson, we go even deeper. We are going to look at accumulation and distribution, how the smart money quietly builds or exits massive positions, and how you can see their footprints on the chart using volume. It is like learning to read the invisible hand of the market. That is lesson 14, and you do not want to miss it. Subscribe, hit the bell. New lessons every Sunday, Tuesday, and Thursday. If this helped you, smash that like button and send this to a friend who keeps buying fading rallies. Go practice, protect your capital, and I will see you in the next one. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions.